Ladies and gentlemen, welcome to another episode of Invest Sense webinar series. And today the topic is very interesting, and it's Monarch's proprietary note. The topic is scary part of super quality stocks, and the continuation is hiding in plain sight. So that says a lot about the topic, and we're going to discuss it. Let me quickly introduce you to Abhisar and the Monarch Net Worth Capital team. He represents the AIF business. So they had launched their maiden fund in October 2020, which was largely a fund that was where the fundraise was done through close associates and people they knew. The fund has done some good performance and has delivered a post fees and expense absolute return of 61% till January 2022 from October 2020 versus Nifty 500 31.6%. So they've done good performance, and in general they have from time to time contributed to a lot of good notes to the investing community. And if you their current their recent note, which goes by the title as the webinar is, has been quite popular, but they have also published such notes from time to time. So you can take a look, as we will be sharing the link. And let me introduce you to Abhisar. So Abhisar, like I said, takes care of the PMS of the AIF business at Monarch Net Worth Capital. He is an MBA in finance from Jain Center of Global Management and a CFA charter holder. He's close to 14 years of experience in equity markets, and before Monarch, he was with Centrum Broking and has won a lot of best analyst awards from Reuters and other such agencies. He's also been presented with multiple stock selection awards across AMCs like HDFC AMC, ICICI Pru AMC, and Aditya Birla AMC. He was also associated with the ICICI Securities and TCS earlier in his career, and very passionate about equities, and considers Mr. Buffett, Peter Lynch, and Joel Greenblatt amongst his inspirations. So welcome, Abhisar, to the show, and we're very excited to hear from you about the topic. And let me introduce PMS AIF World to all you patient listeners. I'm Sankalpo. I represent the business development team of PMS AIF World. We are India's, one of India's leading and one of the first platform for PMS and AIF investing. We have done a lot of good quality content, as you have, been so kind and rewarded us with your kind attention and audience. We continue to do the good work. If you're watching this on YouTube, please do subscribe to us and leave a comment or perspective on how you want us to improve. So that is about us. We are also soon going to do India's only PMS and AIF awards in the second week of Feb, on 11th and 12th of Feb, the weekend. So please, be there with us. Abhisar, with that, let's come back to the topic that we have to discuss today. And it's a very interesting note. And, the market correction has also been testament to the fact that there could be some valuation bubbles. Although valuation bubbles are something, not less than a sinister word in the markets today. As you have mentioned in your note also, since 2016, there has been some kind of, attraction or some kind of affinity towards otherwise which are called as growth or quality stocks. And you have done some data crunching. So, I'll hand over the floor to you and present to the audience how you and how Monarch thinks about those stocks. Over to you, Abhisar.
Yeah, sure. So thanks, Sankalp, for that introduction and for some nice words about the note. So thanks to all the participants also for taking out time to attend this webinar. I'll go straight into our PPT which I've prepared for this. And as you can see from the topic that we had put out, I have divided this presentation or this discussion into two parts. So I'll spend around 15 odd minutes on each of the part, 15 to 20 minutes max. First, I'll talk to you on the scary side of super quality stocks as we see it, and as we have covered in our detailed note recently. And we also will talk a little bit about, how from time to time some popular investing narratives come into the market and make it sound that investing can be very simple, very easy to implement. but it could not be like that, and investors need to think of investing on a more rational way. Second part is that I'll discuss about our investment style and our strategy on how we go about selecting the stocks. And lastly, a quick snapshot of our performance and our value proposition for the investors. So, starting with the first section, the first I want to delve into this very important topic that, we keep coming across, that generally the investing is sometimes, reduced to some popular narratives, and these narratives keep changing every 3 to 5 year based on how the wind is blowing. And I've listed a few of them here that, first of one, which we're seeing now for the last 3 to 5 years, is that, it is being said that you just pick up a select, 20, 25, or maybe 30 very high quality names, and you can invest in them at any valuations, and you're sure to make money. If not in 1 2 years, you're sure to make money in 3 years, 5 years, 10 years. So valuation can be disregarded. That is one. Second is, which is going on, that one must invest in disruptive businesses, or one should invest in disruptive businesses. And again, here also you can ignore the valuations, or you should try and value them differently. You should freely maybe use price to sales with aggressive multiples. Again, this is a sort of a narrative which may, sometimes leave out the rationality part and become a little bit talk of the town when it's going hot. Okay. And the last one is also, in terms of what not to do, that you should not touch only any cyclical infra or asset heavy sectors at all valuations, even if, the things are changing, or even if the odds are extremely in your favor. These things can be best avoided. So basically, what we're trying to say is that, these are the narratives which sometimes come into the market, and investing is basically, sounded to be really, really simple to implement. However, our take on this is that, the reality of investing is that every strategy, even my strategy or anybody's strategy, is something which involves risk. Every strategy involves risk, and sound investing needs to balance the risk reward. Generally, what, as I said, last 3 year, 5 year trends are extrapolated by the intermediaries, by, various people in the market, and then in the process, what it does is that the risks are basically sidelined or forgotten by the investors. So, how we see investing is that it's not about picking a style like a growth style or a value style. It's more about, being rational and practicing rational investing across time periods. So with this, let me just jump straight into, what we could, see, and we put it out in writing with a detailed note, which we released on 3rd of January, about, the scary side of super quality stocks. And what this note talks about, and I'll request Sankalpo to share the link also in the chat for any of you to download. The link is mentioned here also. So it basically talks about, the valuation excesses that we see, which could leave the investors with, years of time and value correction. So what we did was that, we formed a basket of super quality stocks by applying, some of the very basic filters. So basically, we look for companies which have always grown, which continue to grow their EBITDA year after year, 7 year EBITDA, 7 year PAT CAGR, both above 10% with amazing consistency. They will always have a very good ROC, at least above 15%. They're also trading at, decently high valuation multiple, and their corporate governance is top notch. So basically, market is very confident on them that the quality, governance, growth are all in place. One more very important filter we applied is that we took at least 10 years of financial data companies only. So any company which is recently listed, which has less than 5 years of data, which is less than 10 years of data, we've not taken. So we don't want to take companies which are not there in the market for very long, and hence valuation could be all over the place. We want to take something which is now well known, well researched. It has history of valuation and the market cap above 5,000 crore. So we could form a basket of 55 stocks, and then we tried to track, what has happened to the valuation of this basket, since these companies are so good in terms of growth, return ratios, corporate governance. And the findings were like mind blowing, as you can see from these tables. The valuation for this basket, it's not just 10 stocks, 15 stocks, it's a basket of 55 stocks. The valuation on a trailing basis has seen 100% increase versus its own 7-year average of this own basket. And versus the average of FY 12 to 17 of this very basket, the increase is between 170 to 200%. So the multiple has gone 3x, on a EV EBITDA for this same basket, which used to trade at 15 times EV EBITDA. It is now trading at 49 times, and same is on the PE side. So effectively, the re-rating has been very strong, and it is basically one more thing which we saw was that the re-rating has been relentless from FY 16 and 17 onwards. Every year the multiples have increased. So we kind of sat back and decided to think that, is there some plausible reasons? Are there some real reasons, why this kind of re-rating may have happened? And what we could see was that actually there have been a lot of disruptive events on the ground, one by one, which have been very closely spaced, as which you all know. I've just put it across here. We have had demon, we have had GST, we have NBFC crisis, we have had COVID going on for 2 years now, and all these events made the stronger companies stand on their feet better versus the overall market. And from an investor point of view, they became safe havens, that look, these companies have no existential issues in these times, right? Of course they don't have, which we fully agree to. And then, with the continuously investors putting incremental money into these companies, what happened was that the premium for quality, which was justified, has slowly moved to an unsustainable valuation, sort of a bubble or an incredible multiple, which may or may not be justified. In our view, it's looking a little unjustified to have such kind of multiples, and which may have happened because of these things. And now we are seeing that, the early signs of valuation normalization may be taking place, which may take its own sweet time. I'm not saying that these things can correct over a 1 quarter, 1 year, 2 year. It may take 3 years, 5 years to fully normalize. Like the way it has gone to this extreme, it may take its time to come back also. So now, but at the end of the day, we as asset managers, need to have a framework to how to do, what to do with these kind of stocks. So that's the $1 million question. It's very easy to say, that these are trading at high P, so you don't buy them or avoid them, or investing in them is not prudent. But it's not so. I'm not trying to say that none of these companies can be wealth creators. What we did then is that. We try to rationally work with the framework of how to decide on these stocks. And we did a red and green flag analysis. As you can see in this table and also in our report, it's a very self-explanatory thing. We have given a red flag to a company which is in this basket, and still the EBITDA and the PAT CAGR is below 10%. So you are valued so highly, and your historical EBITDA and PAT CAGR has not even been 10%. That's a red flag for us. Same way, if your ROC is less than 20% and you're getting such a high multiple, it's a red flag as defined by us. Whereas if you are 25% plus ROC, we are happy to give you a green flag. Same way, we have looked at the expansion in the valuation multiples, and decided on the red flag and the green flag, and on the growth multiple, the PEG multiple, as we say, or the EV to sales, same way. And then we have said that, look, the scary stocks within this 55 basket, the scary super quality stocks could be the one which have more than 6 red flags. I have 9 flags here. And if, a company is getting 6 red flags and is also valued like the way it is, then it is basically, I have qualified it as a scary super quality stock. And same way, the ones with more than 5 green flags is a relatively safe super quality stock. So once we did this analysis, we found that out of 55, almost 30 odd companies were in the scary basket. The safe basket had only a handful of 3, 4 companies, and the rest 20 companies were in no man's land. Actually, they were having 3 green flags, 3 red flags. Then we tried to do, that if we even take very aggressive optimistic assumptions, what could be the returns that you can make on a reasonable expectation basis? And what we did was that we assumed that they can do a 20% EBITDA CAGR for the next 3 years on their trailing EBITDA. So by the way, as you all know, trailing EBITDA itself of these companies are quite high, since in the post-COVID world, based on pent-up demand, every company did very well in the H2 of last fiscal year. And H1 also of this fiscal year, the companies have done okayish. Though June quarter was slightly subdued due to second wave, but they have done okay. So the trailing 12-month EBITDA is a really high number. On that high number, we've taken a 20% EBITDA CAGR continuously for next 3 years. And we have assumed that the EV EBITDA multiple, which is a better multiple in our view versus a P shorthand, we've assumed that the EV EBITDA multiple will come back to its decent average premium to its 7-year average, around say a 10%. On doing that, we found that 44 stocks out of 55 in our basket are giving less than 10% stock CAGR in the next 3 years. So basically, this is what is priced in. Effectively, the ask rate on the earnings or the ask rate on the multiples remaining high is too high for these companies. And I now want to take you through a few of the global examples. By the way, as a disclaimer, we are not trying to say a buy or a sell on any company here. So please note that it is just an exercise which we are trying to do in terms of telling you that look, this is the kind of a ask rate which is coming in these kind of companies. And now coming to these global examples, wherein in the past, when such kind of things have happened that the ask rate is so high, then even when the earnings have gone up 5x, 10x time, the stocks have not given the CAGR. And I want to give you an example of Twitter, which did an IPO in 2013. And at that time they were making a cash flow of $80 million annually, though they were negative on the PAT and EBITDA, and they had a very good revenue of $700 million at the IPO time. Okay, and they could command a valuation of $14 billion at IPO, just like you see our new age tech IPOs also listing at 10 to $15 billion kind of valuations with negative EBITDA PAT and maybe with negative OCF. Twitter had a positive OCF. Okay, and it took a valuation which was 20 time price to sales and 170 time price to cash flow. Of course, EBITDA and PAT were negative. And on listing day, it went up 70% also, by the way. And so it closed on the listing day at 36 time price to sales. Now, in the next 8 years to today, Twitter has increased its operating cash flow 12 times. 80 million has gone to $1 billion. Whereas the stock price has fallen by $10 from 45 to 35, the market cap is almost flattish, right? And now it is EBITDA and PAT positive company. The revenues have gone 7x from 700 million to $4.8 billion. And it's the mighty Twitter with the world's best celebrities, with millions of followers, with celebrities tweeting anything and people, having huge number of likes and comments and all kinds of revenue streams. But now the price to cash flow multiple is a good 28 times and the price to sales is a more reasonable 5 times. So earnings went up 12 times and the stock went nowhere. Same way with Netflix in last 3 years, PAT has gone up 5x from $1 billion to $5 billion. Stock price is flat and the PE has fallen from 150 to 35. So basically, I'm trying to say that, when the stock is at a supernormal valuation, sometimes even supernormal earnings, don't end up moving the stock, because then the market tries to see whether again from this base the earnings can go up another 5 times, 4 times, and that becomes difficult even for the best of the businesses. And the same thing happened in 1970s in the US also, wherein this basket, which was again called Nifty 50 only by coincidence, it was a basket of 50 blue chip stocks of 1970s. You can see the names here: McDonald's, Walt Disney, Coca-Cola, PepsiCo, all the great names were there. Now, these were so heavily moated companies that, they used to grow their earnings every single year. And they kept on doing. They're even growing it today, many of them, right? And they were valued at a basket of 105 times. Many of them were at 80 times. Some of them were at 30 times. And then next 10 years, the returns from these basket was negative for everything which was more than 50, 60 times. Whereas it was a single digit CAGR for many companies which were even at 30 times. So, and by the way, they kept on growing their earnings because, they were so good and so loved product companies like McDonald's, Walt Disney, Coca-Cola. All these products kept the consumption going of their products and services. But the stocks CAGR then improved only when you held it for 20 years, 30 years. So if you held then 20 years, then you reach the double digit CAGRs, but first 10 years it was quite painful. So, these are the kind of things which we have to keep in mind as investors when we are looking at stocks. And last point I want to make here is that when we look at any stocks, in India, which are very heavily moated companies and which are trading at very high valuation, we should keep in mind that now it's a global market. Investing anywhere in the world has become more easier and easier. Many funds can raise money today in India and invest abroad, and you have many companies globally with much higher moats, much higher CAGR, and much higher ROE, ROC available at one third or half the valuation. So Apple today trades at 20 times EV/EBITDA. Apple yesterday reported results with $100 billion of earnings annually, and it trades at 3 trillion, which is 30p. Same way for Alphabet, Google, which is trading at 19 times EV/EBITDA, and we have here our basket of 55 super quality stocks at 45 to 50 time EBITDA. So, we have to keep that in mind that even the most loved franchises globally with very heavy moats, with global markets, where they're growing so well, are, traded at a certain rational level of multiple, which is high, in fact, for them also, as such. So this is basically what we have tried to, cover, and this is where my first part of the presentation is largely finished. I will finish with one anecdote here that, what Mr. Warren Buffett says is that investing is very simple but not easy. Basically, we should not have narratives which make you believe that investing can be very easy. It will always have some of the risks which are hidden. And if the stock price has defied gravity, to move up, either just at the listing time or in the last 5 years, then earnings also have to defy gravity, and go up in that same way. Otherwise, gravity is not going anywhere. The gravity will have its impact felt, and will remove the imbalance. So that's what I think we should keep in mind as investors. And as we investors for our fund, we keep this in mind at all times. And that's where I will come to the next topic now, which is basically like how do we do it? How do we go about selecting the stocks that we do for our fund? So see, at Monarch AIF, we run a very concentrated portfolio of between 15 to 20 positions, and for any position that we select in the portfolio, we look at three key things. The first, as you can see in this PPT, is the cash flow growth, and this is something we always look for. We are happy if the P&L, EBITDA, and PAT growth is slightly lower, but the operating cash flow growth is in, say, a double digit, whether it is early teens, mid teens, high teens. That depends on the type of business we are picking, but we want the cash flow growth over last 5 years, 7 years, and generally that will come only if the EBITDA to cash flow conversion is good, which we want. Second thing we look for is that whether the business is incrementally improving its return on capital employed. So what we mean by this is that if suppose a business is there which has been generating say 15% ROE as an average over last 7 years, 10 years, and but in the last 3 years on incremental capital which has gone into the business, has he been able to generate say 17, 18%, more than 15? Has he been able to get more returns from the capital employed in the business, which may be due to economies of scale, which may be due to more efficient capex, which may be due to new product services, which may be due to some cost efficiencies, but he's able to do it. And lastly, the third point is that whether the growth is more organically funded, internally funded, and he is not taking extreme risk, because in the Indian market there can be various kinds of events. As I showed you, there have been in last 5 years so many disruptive events, the policies of the government, the regulatory risks. So we want that the balance sheet should not be funding the growth in a very risk-based manner. And lastly, of course, something which you would have guessed by now, that the valuation side, we after having these things in place, we don't like to pay just crazily above the top. So, when we do these kind of filterings, and particularly our incremental ROC filter is something which we use very extensively, and the cash flow filter, we end up with working with or having 70 to 75 or max 100 companies to work with, which we then shortlist or keep in our radar to come down to the 20 stocks. So I'll give you a few examples, so that you can relate to this better, in terms of some of the stocks that were part of our portfolio, have been part of our portfolio. Just a disclaimer that nothing is a recommendation here. This is just example that we get, companies which have these kind of metrics at very, very nice valuations also in the market. So we have had a large cable and wire player in the portfolio for very long, since inception. We own it today also. They were basically, after the IPO for the 2 years, the stock was going nowhere. Largely, it was available at a very decent 15, 17, 18 P or EV EBITDA, maybe of 10 times, 12 times. But it was constantly improving its ROE, ROCs. It was having a cash flow CAGR. There were no concerns in terms of large concerns on the corporate governance. It was audited by Big Four always. Promoter had 70% skin in the game, and it has leadership position. Now, what we see is that, slowly the market is realizing the re-rating is happening, while the other parameters like
Hello, Abhisar, your voice screen froze. Okay, so we'll just get Abhisar back. In the meanwhile, let me just discuss the poll results that we we're doing from time to time. So the first question that was asked was, if there's a valuation bubble in so-called quality stocks. Uh, 58% said yes, 20% no, and 20% can't say. So 40% people in the call are still not fully convinced that there might be or there might not be a valuation bubble. The next question that we asked was, what do I prefer? Quality at any price, quality at reasonable price, or value with growth? Quality at reasonable price seems the most popular choice at 31% of the votes. And the last question that we asked so far is, what do you first look in a company when you invest? So valuations, growth in profit and revenue, moat and corporate governance, and trend in stock prices. 40% of the people on the call say they prefer to look at growth in profit and revenue first. So what do you?
yeah.
I see you back, Abhisar. So continue
Yeah,
with the
yeah.
presentation.
I'm really sorry. That's for some connection issue. I was off for a minute. So, that's what I was just saying, that with all the parameters in place, there are good companies which are available for the picking, which may not be among only the very popular, very high P companies. They are more reasonably priced, and they may or may not be popular. They can become popular over time, or they are already popular, but they are reasonable. So that is one thing which we keep in mind. So effectively, our style is in terms of picking, potential doublers in 3 to 4 years and steady compounders. On the doubler side, we feel that the multiples are really depressed, and there can be some returns to be made from multiples also. On the compounder side, we look for entering at, fair valuations where we can continue to make the earning growth, as per our filters and strategies. So I'll quickly give you, two examples, also from say, from the live market, from today's market, that, where we see the stocks, clearing all these kind of filters that I mentioned, but are trading at a very attractive valuations, or not a very high P valuation, high multiple valuation. So we have a niche housing finance lender, which we feel is at an inflection point in earnings. Anyways, they have always grown their book and their earnings and their EPS very, very well, in the high teens, close to 20% across periods. And the best part where they are unmatched is that their book quality has been pristine. So the GNPAs have remained below 0.6, 0.7% on an average across cycles, be it demon, be it any other disruption which may have happened. And the real estate cycle, as you all know, have not been that great in last 7, 8 years. And now everybody says that it will be very, very good in the next 5 years. We also feel okay. So that time, we feel a company like this, which in last 7, 8 years has been able to manage its affairs and grow very, very well, available at trailing price to book of 3, and a forward 1 year forward price to book of 2 times. It looks like, clears all our filter, and is also fairly valued to be in the compounder category. If the multiple increases by the market, then there can be a slightly higher earnings CAGR, stock CAGR, which can be made. That's how we look at it. Second example is again, very good cash flow generating business in a consumable business, in an industrial consumable of refractories, wherein the MNC players trade at very high multiples. They are loved by everyone in the market. Okay, but there is a third player, which also has a very nice track record. Only the reported ROE ROCs look slightly lower because of goodwill, the impact of which is going away, and incrementally it has been improving its ROE ROCs consistently. The cash flow generation is top notch. The management is top notch, audited by Big Four since last 10 years. There's no CG issues, and the growth outlook is really good. And now this kind of a business is trading at a trailing EV/EBITDA of 5x, whereas the its own peer in the MNC space trades at 22 times EV/EBITDA. It's almost at a 6x market cap to this company with just 100 crore of extra EBITDA. This company is having an EBITDA of 160 to 180 crore. That company is having 270 to 80 crore, and maybe 6 times the valuation. So basically, I'm not saying just from a valuation perspective we are picking this. It is clearing most of the filters of quality, growth, return ratios, and then a valuation discount in a business which is non-cyclical. So basically, this is how I would give you these two examples in related to our strategy. From what we've not already picked, we may have, but from a point of view that in every kind of a market, okay, where you may have so much of high valuation in some pockets, you will also have instances like these, wherein you will get the ingredients that you're looking for, and still a valuation which will not be creating a lot of risk for the portfolio in terms of not being able to generate returns. Of course, you have to spend time. You have to own these businesses. Nothing can happen overnight in terms of re-rating. It can take its own time. Some of the businesses take a lot of time in getting re-rated and noticed in the market, but that's what the market is, right? So now I've come to the last part, and I'll quickly cover it in 2 minutes in terms of our value proposition. How do we look at it? So I keep thinking about this, and I sometimes get asked also, by the HNI investors that, how do we add value as a fund manager? How do any fund manager go about adding value? And I've thought a lot about it, and then I've gone through a very good piece from Mr. Michael Mobosin on this very topic. Whereas the fund manager has to do two tasks. One is that he should have a decent betting average, which means that how many positions he enters and how many of them go right. And no fund manager can get all 100 positions right. So betting average above 65%, 70% is considered really good. But what is most important, where many fund managers do excellently well and some managers are not able to do so well, is the slugging ratio. Whereas basically what that means is that in your winner, how much are the profits that you are realizing, and in your losers, how many are you losing? And this depends on both the position size and the duration for which the position is held. So basically, how you can best manage the slugging ratio is when you are working with a concentrated portfolio, and you can keep your winners held long enough, and wherever you have gone wrong, because nobody can have a higher strike rate of 100%, as I mentioned, the losers are cut on time or not exited too late. Sometimes a winner can also turn into a loser because of a management action, because of some very bad step by the management or something like that, wherein you will have to also act accordingly in time. So how we try to do it is that we work very hard on the slugging ratio. We don't crave for having a betting average of 80, 90, 100%, because sometimes it can be impossible, and sometimes it can be event driven also, wherein a call can go wrong. Okay. But what we try to do is that we work with a concentrated portfolio of 15 to 20 stocks, and then work on our slugging ratio, that where skill, temperament, and all those things can count, and we can keep a low churn and a high slugging ratio. So this is how we do it. And Just a quick snapshot of our fund. In the last 12 months, we have done around 45%, and since inception, post all fees, we are around 61%. We run a closed-ended fund which is live and running, and we have a new fund offering, which is the Cat 3 closed-ended long-only fund, MNCL Capital Compounder Fund 1. And we have a very competitive fund of a fixed fee structure with a differentiated approach. We have no exit loads. We have profit sharing of only 15% once we cross a hurdle of 10% odd. So basically, we work with a low fixed fee, limited intermediary, and fee structure design on performance, largely. So that's about it. Thanks a lot for your patient listening. I hope the session was interesting, and didn't bore you. So over to you, Sankalpo, for taking the questions from
Right.
the presentation.
Right. Thank you so much, Abhisar. And that was very interesting, and especially coming off the recent correction that has happened over the last week, not just in India but globally. And tech stocks have taken a lot of the beating. So thank you to the audience. Please keep sharing the questions that you have. Now we will try to take most of them. Couple of people have said this is a good presentation and the best one so far on our channel. So that is to you, Abhisar, and your team. Well done. Yes, we will be uploading the recording of this video on YouTube for everyone to see. So the first question that I'll take is from the audience. Mr. Srivastava is asking. He says, "Agree with all you said, but what's the alternative?" I think he's referring to the question about quality and buying quality at any price. So if you can just take that and tell us, just give an indicative alternative. Again, let us give a disclaimer that it is just more academic than advice. So what do you?
Yeah. Yeah, sure. So see, I tried to, already allude to that question in the PPT and the way that we also try to go about selecting the stocks. Okay. So while, it is really tempting to invest in companies which are so consistent and where the multiples have been re-rating year after year. So maybe, even 1 year back or 2 year back, I could have put the same PPT and maybe the P and EV EBITDA multiple would have been slightly lower, and still those stocks have given a much more CAGR and now are even higher valued. So the point is very valid that, look, if we avoid this because we know valuations are high, then what should we do? And that's why I gave that framework that, you can first try within the high quality to be very sure where the earnings growth can be very high, so that some of that valuation can be justified. In fact, of course, I showed you that Netflix has done its earnings 3x in 5x in last 3 years. It's still flat. Twitter has done it 12x in last 8 years. It's flat versus IPO. So you have to be careful. Even the most popular of the companies, when they don't give you returns for elongated period, it can happen. As an alternate, as I showed you examples across sectors, Sankalp, and the audience, there are companies which will clear these parameters. Okay, they might not be the talk of the town, or there you may have to keep patience when they are cheap, that you keep holding them, but they re-rate over time when they grow their earnings. And that's where you can do the hard work or go with the fund manager who is doing the hard work of finding those companies which are having those potential to grow their earnings. And now I think with the way the economy is shaping up, Sankalpo, and we have reforms across sectors, which I don't need to talk about. Enough has been talked about by my better peers in the market and other celebrated fund managers in terms of the reforms. And we will have performers or the companies across sectors now. We will have very good some of the infra companies in the next 10 years. We will have companies in capital goods which will do well, we'll have companies in the metal sector which can consistently generate cash flows, free cash flows, maybe return those cash flows to shareholders. And so, you will have more choices. We'll of course have many companies in the tech side also which will do amazingly well. You will have to choose maybe promoters who are still holding a very high skin in the game, which have not diluted everything in the IPO and already in cash, and which can grow the earnings like that. So these are the alternatives which you can think of. And I gave you examples also where within financials as well as in an industrial consumable, you have everything which you would want to see as an investor, and still a very decent multiple.
Right. Thank you. Very detailed, very detailed. So again, what I'm going to come to is the next question. Mr. Anand Archak has asked. He's one of our most patient listeners and has been joined us on many webinars. Thank you, sir. So that he said Asian Paints has made a 52-week high literally every year over the last 15 years. Okay, so he specifically asks about Asian Paints, but we will take it to a more broader context because you have done your study, like you said.
Yeah,
Twitter and Netflix and even India, Reliance did not do anything for 10, I think close to 10 years or so.
yeah,
This HUL was also in some kind of a rut there. Even stocks like Nestle or MNCs like that, consumer MNCs, PNG or Gillette still haven't, done anything performance wise. So what do you think, then that the premium companies like Asian Paints or peers like Bajaj Finance, HDFC franchises, the premium that they get, isn't it now a more perpetual thing? We have an entire generation of investors grown up seeing
yeah.
that these companies get some kind of premium. Do you think that will change so soon, or what is your view?
So see, again, here my view is very, very simple and straightforward. See, these companies are really exceptional. So no two ways about it. Okay. The good part is that they have been exceptional throughout. Okay, and every single year they can grow their earnings. Now the only point is that in last 5 to 7 years, their stock price is going up much higher than their earnings are going up. So every year they are seeing re-rating. Now that can't be infinite, okay? Because of course the multiple can keep increasing maybe for 3 more years. I don't know, okay, for a Asian Paint or for any other company, which is so much well in execution and which is so loved. But as I said, finally, if the stock price has defied gravity, okay, then the earnings will also have to defy gravity, because gravity is not going to go anywhere. It will take its own path to remove the imbalance, if at all it is there. And knowing these managements, Sankalpo, these managements are very prudent, so they can try to enter adjacency, they can try to do more things to grow faster, okay, but they will not do something which can, in terms of growing faster or justifying their market cap, destroy their franchise or destroy their cash flow or destroy the capital. So see, these companies will not care that I have to justify a 3 lakh crore market cap, so should do something, for it. Okay, and that's why you will see that they have been so prudent. So in that case, you as an investor have to decide that, look, is there a balance, or the balance is just tilting more and more and more, and I could be in for a 5 year or a 10 year period, like we saw in the US blue chip stocks. McDonald's, from that till now also has grown the earnings, but for 10 years it couldn't do anything, and then if you held for 30 years, you could make a 12% CAGR. It is still a great company, its product is still more loved, and then they were selling only in US, now they sell everywhere. Maybe Indians have now consumed much more than maybe US can consume. So so something like that, and this is the way to think about it. I don't have a specific view. As I said, we are not trying to say a buy or a sell. We have nothing against any company, any stock, any business, any portfolio. Per se, what we are trying to say is that you have to keep this rationality, and keep thinking about that. Look, stock is defying gravity, whether the earnings can also defy gravity in the future.
Right. That's very detailed and very good perspective. The next question is probably one of the most interesting ones, and Ashrut asks the real question probably: how to deal with stocks that become super expensive in your portfolio? So that's, I think, something everyone is interested in listening to.
Yeah, sure. So see, even when say we see at the point of entry, it is every investor's choice. First of all, okay, that whether he feels that there is a rational case for entering at a very high valuation, and then can he make money even in a 3 year, 5 year period. I'm not talking about 1 year, 2 year. I'm saying that once you feel that even in a 3 year, 5 year period, it could be a little bit rationally, it might be difficult, and you may not want to enter. That is at that point of entry. Once you have something in the portfolio, which you have entered at say a more reasonable valuation, and it has just been going up, and maybe now it is going into that kind of a valuation zone wherein earnings are going only at a certain pace, but valuations are consistently increasing, then it becomes really tough, because as I said, on a slugging ratio, you need to really work hard, okay, in terms of being able to maximize profits from your winners. And see, in these cases, Sankalpo, there is no real, easy answer. What I and my experience and my reading of the world's best investors shows is that you got to do a smart weight management. In such cases, may not want to exit the position completely, and you have to have a very smart and a deep hawkeye on the execution, because in such cases, if the execution falters, then the fall can be very sharp. Okay. But if you are very sure on the execution, and you are maybe taking part profits out, or maybe reducing the position, not let it become 20, 30, 40% of your portfolio, but you are still there, then you will be able to ride. Because see, it's not easy to identify the tomorrow's Amazon who can do 100x of its earnings in the next 20 years, or the Apple. And see, these are once in a decade kind of a businesses which come and which happen for the people who are invested in them. What we can do is we can try to find, if we get confidence, like, look, earnings are going to go 5x, 10x with very high certainty, you can have it for high valuation. But otherwise, do a smart weight management, and if execution is faltering, be very quick to react.
Right. So that's a very clever answer, very smart answer. I hope investors take something from that. Again, it's more academic than actual advice, as a disclaimer. Okay,
Yes.
so the next question is from Mr. Sagar Kapoor. He asks, do you see valuations rising across the board, given the increased participation and easier cash coming in? And like I can tell you the top 55 stocks that you mentioned. I was just going through the list earlier also, where the question comes from is that these are the more popular stocks.
Yeah.
Investor on this, watching television or looking at reports from brokerages will most likely come in contact with these stocks or know about these
Yes.
stocks. And this is more or less the universe that he'll interact with. So what happens then? How do you how I mean, you have at your disposal some kind of experience and knowledge that you have accumulated over your 14-15 years of career, but
Right.
a lot of my viewers today and people who watch it on YouTube might not. So what's your
Right.
advice to them?
No, so that's why, it is said that, following a set narrative, okay, or just thinking that it is going to be very easy if I select 10, 15 companies as an individual and then just leave it, whether I can make a CAGR. And that's why, Sankalpo, so many times we see that the index is able to beat, because index is a mix of everything. Today, if you buy an index Nifty 50, you will get the PSU banks also, like SBI. You will get the bigger oil companies also. You will get the IT companies also. You will get the Reliance also. You will get the banking stocks which are cheaper and costlier both. And that's why beating the index itself becomes difficult if you're just following a narrative without following a rational backup on the investment that you're making. And hence, our point is, as I said, we may ourselves could be picking some of the stocks within these 55 stocks at any given point of time, or we may have picked, or we may have invested in the past, or we may be invested even today. My point is different. My point is that, when we are taking that decision, are we doing a decent rational analysis, or we are just getting influenced by the more recent 3 year, 5 year, 7 year performance, and then taking it for granted that this will go on. Okay. So what we have found out is that it can go to extreme, and nobody knows the timing. Nobody knows of the timing, whether this will first go from 80p to 120p and then start correcting, or whether the normalization has already started. And all we are saying is that, look, you have to have a mix. You'll have to have a little bit of a rationality to make that double digit CAGR and beat the index, or beat your other returns. Otherwise, of course, you have to go to a good fund manager who can do the job for you, or invest in an index fund, right?
Right. That's very intuitive. Thank you, Abhisar, on that. So the question then comes is, then from time to time, does your portfolio become more of from time to time, do you have to churn too much in your portfolio if you follow that approach? Because what is classical investing is that you invest for the long term. If it's a good company, it can remain good forever, is what we have. What a lot of investment leaders have also taught us, and maybe with some kind of conviction there. How often do you do this exercise? Maybe is it an annual exercise, or How do you evaluate that, boss? This is where I should adjust the weight in my portfolio. And Mr. Prashant asked this question.
Yeah.
So over to you.
Yeah, sure. So see the normal exercise of testing the valuation in the portfolio or any specific company in the portfolio is an ongoing exercise. And see there is no threshold, Sankalpo, that if it crosses this and I'll start reducing. It's not a switch which I keep adjusting on a very very frequent basis. Mm, all what we try to do is we try to remain true to our strategy. Okay, so our four filters, most of the times we are trying to follow, because see, we believe in that strategy. See, first of all, there can be various different strategies, as all our investors know, and various different strategies can equally do really well. Okay, there's no one specific strategy which will only do well in the market. That is very very clear in our head. So we are not for or against any strategy, first of all. In our own strategy, we try to follow that the parameters that we are looking, how much they are clearing. On valuation, we know we have to have flexibility. Okay, I'm not saying, and here when it is going to such an extreme, that time I'm trying to tell the investors that you have to be cautious, be cautious about it. Okay, there are enough examples from the past wherein earnings alone couldn't help the stock price. Otherwise, you tell me that is Twitter not the most popular platform which can monetize in so many different ways? Okay, and the IPO closing price on the IPO day and the today's price is 30% lower, 20% lower. So what I'm trying to do, and in the portfolio, if we see any company which we really like and is going above the valuation comfort zone, then as I said, I try to do the weight management, and we are closing. We are tracking the earnings trajectory even more closer, because we know then if there is any change in the outlook, any falteration in the earnings, then the effect of the gravity will be very fast. Okay, so it's tough. It's a tough question. It's not an on off button which the investors need to understand. But it can be managed, and as I said, Sankalpo, as the market broadens, see, market is still broadening, and we have more sectors which are starting to do well, and we have had a tough 10 years where a lot of reforms had to be taken, and they have been taken, and a lot of balance sheet cleaning had to be taken at the corporate level as well as the bank level, as we all know, right? So once that has taken place, now, Sankalpo, in the Indian market, the investors will have many, many more options, which in the last 10 years they were not having. Okay. So they had to go and keep on finding this hiding place in the top 100 or the top 50 or top 100 stocks. Whereas Indian promoters are also learning the lessons of good corporate governance and the impact of the same on the valuation and the wealth creation for them as well as their investors. So I think with those things in mind, it can be a fine balance maintained by investors or by funds at their own level for investing.
Right, right. Thank you so much. So I've got a question from a friend on WhatsApp, and so I think this is very Twitter specific question. So she says, like you mentioned, Asian Paints is a perpetual growth machine. So they've achieved growth. More or less, they've grown every year in terms of business as well. So she asks, can Twitter or Netflix be a deviation from the usual, where a 10 years time frame also couldn't budge their share prices, and could it be because issues like sharing data with specific geographies, or the sovereign, or any other such issues? Maybe Netflix hasn't found much success beyond the developed markets.
Yeah.
Do you think that can be a more common exception than there being a bubble in quality? So I'm asking an anticlimactic question towards the end, but I found it very interesting.
No, so see, there could be various reasons. Okay, it's very difficult to pinpoint any reason for any stock. See, that's why I even gave the example of the 50 blue chip stocks of the US in the 1970s,
Right.
which as a basket was at a 45-50 type of a P. And at that time, the index was at 20p and this basket was at a 50p. Today, our index is at say 25p and this basket which we created is at a 80 trailing P. with TTM earnings not being subdued, by the way.
Right.
And EV EBITDA wise, it is even more stark. So see, only point I'm trying, see, I am not against an Asian Paint or a Pidilite or a Page Industry. Please, get that clear in the head. What I'm trying to say is that if at all, the stock is at the level at what it is, and it is reached by defying gravity, okay, earnings will also have to do that same thing. It will not be a perpetual thing that he can remain at this multiple or keep increasing it year after year. There is a there is a limit. Okay, so basically now whether a Netflix or a Twitter is not able to find so many adjacencies, and they have regulatory risks and they have data related issues and all those kind of stuff, and that's why maybe they are not re-rating. But we are seeing it everywhere, Sankalpo. Okay, even for a company like say a Apple or a Facebook or a Amazon, which are growing the earnings year after year at a certain base, their multiples are stabilizing at a certain level. Maybe now there you will say that $100 billion is now Apple's PAT, so वो कितना grow कर जाएगा? So that's why it is at 25 times. I don't want to give it 80 times. Okay, but we all love Apple's product. God knows what they can come out with tomorrow, which again you and me would want to buy. Okay,
Right.
so I am trying to say that look, Asian Paint may be able to sustain its valuation. It may go from here also double. Okay, if it can find some avenues or some products which we will love as much as we love their current products. Okay, as a consumer, and where they have gone and made a 50% market share. But to assume that their multiples can never stabilize at a slightly lower level. Okay, and in the past they have, by the way, grown earnings at a certain pace only. Okay, they've not gone ahead and done things to grow at 30%, 40%, acquire something right, left, center. Okay, so these managements are prudent. They know that if they do that, then they'll take a much bigger risk. Okay, and they can break the thesis. So it's a balance, and it's end of the day, your horizon also. Of course, some of these companies can be great companies in even 2050. So a 30-year holding in these companies may make sense. But you should be knowing that there can be a 5-10 year period where you can have these instances which I showed you. Just assuming that those instances can never happen, and perpetual compounding can happen, that is something which is not rational, is what we are trying to say.
Right, right. That's a very fair point. That's a very fair point. So a lot of questions on your portfolio, and we are almost, towards the end. So, just take
Uh,
some time to
we can
explain.
take a few questions on portfolio and our way.
So I
That's
was just
fine.
going to give you the
Yeah.
floor to talk a little bit about your
Uh-huh.
portfolio. There are questions like what is the churn returns? Are
Yeah.
you Are you mid cap, large cap focused? What are you? So questions like that just take a couple of minutes or even slightly more. Also is fine to
Yeah.
put your product about.
Sure. So see, we don't run a PMS. First of all, I think I see some questions that whether
Right.
we run a PMS or we run a AIF. We run a AIF, and we have a single scheme which is a closed-ended fund. So we have not been taking any inflows at all in the last 15 months. This was, by the way, our maiden fund, which we raised organically through our own resources without any intermediaries. So we have been, really as such, in a scene where we've not been raising fund at all. Now, when we do subsequent schemes, which we want to do in the AIF structure only, because we like to work with inflows and outflows which are much more controlled. Okay, and which are not seeing huge amounts of volatility on a daily basis, maybe, which is the case in a PMS. In terms of how we structure our portfolio, our scheme fundamentally is multi-cap, which gives us the flexibility to invest across market cap ranges. But we generally end up, deploying 60 to 70% of the portfolio in less than 20,000 crore market cap companies, or less than 25,000 crore market cap companies, because those are the places where we are able to see the ingredients that I showed in my PPT, and where the valuations are also in our favor. We keep the space 30 to 40% open for larger companies in sectors which are out of favor, and where again, you have those ingredients but valuation very, very in your favor. So what we've seen in the last 20 years, so I don't want to talk any period, any cycle, or what will do well, what will do not well. But what generally we have seen is ki every time, Sankalpo and investors, as you would understand, as you will agree with me, there are 2 3 sectors which are generally out of favor, and even the large caps in those sectors are selling very cheap. Okay, sometimes it happens with banking, and you can get even good banks, decent growth at a good price. Sometimes it can happen with auto. Sometimes it happens with pharma. It happened with pharma when pharma was completely out of favor, right? So there, what we are able to do is that we are able to, pick some large caps from these sectors in our portfolio and have a decent balance in our multi-cap fund. So that's how we do it. 60 to 70% of mid and small caps, which can be below 25,000 crore, and the remaining being the large caps. In terms of the churn, we don't do much of the churn. So for a 20 stock portfolio, in a year we at best may enter between 25 to 30 positions at max. Okay, and the few of them, if there is some change in thesis, they may go out, or a few of them, if they've gone up substantially and we don't see any possible CAGR in the next 3 years on a realistic basis, we may exit. So of course we don't have 100% strike rate, so we have to balance the portfolio accordingly. But that's how we work in terms of the churn. And the AUM also been asked, I think, in the Q&A. Our first fund is a 110 crore fund right now. As I said, there is no inflow in the last 15 months. It's just a starting AUM, which has gone with returns to this level. We are looking to raise our second fund where we'll be hopefully having a larger AUM on the AIF. It's a Cat 3 long only fund that we have been doing.
Right. Thank you so much, Abhisar. So to the audience, thank you for being very patient, and thank you for asking such wonderful questions. Thank you, Abhisar, and thank you to the team at Monarch for writing such a beautiful note. And we wish you all a very, very good performance year ahead and a happy investing year ahead. So thank you for being with us. Hope to see you soon again, Abhisar.
Yeah, thanks a lot, Sankalpo, and thanks to the PMS AIF World team for hosting this webinar. Thanks for all the investors who joined us, who attended this session patiently. Thank you so much.
Thank you, guys.
Thanks a lot. Bye.